7th of January, so price took out this high. Okay, so down to the business for today. So I said I'll be talking about the ICT macros for the London, for the New York PM session. The New York PM session. So the macros is a time whereby the market starts pulling to liquidity or a place of interest. So the New York PM session has its own macros. Okay, times where those particular things happen, whereby price starts pulling to liquidity or a place of interest. Also, the New York AM has its own macro, and the London session has its own macros as well. But since price made clear movements with the New York PM session macro, so we'll be talking about that. So this is a 5 minute time frame, and since we know the bias was bullish, right? And when the bias is bullish, when the bias is bullish for the daily and on the New York AM session, if you notice also the bias is also on the New York AM session. You can see the bullish movement in price. Okay, so you want to watch the New York PM session to see if there will be a continuation of this bullish movement in price. Okay, so it ends at 450. If it was 450. So from 1 p.m. you should start hunting. This is a key zone for the London New York PM session. That's when you start hunting for price. Okay, so like I said, price was bullish at the New York AM session. So you would want to monitor the New York PM session to see if there will be a continuation of that bullishness in price, just like this. There was a continuation. But sometimes when price is bullish at the New York AM session, it tends to be bearish at the New York PM session. Okay, and sometimes when price is bearish here, it tends to be bullish here. Sometimes when price is bearish at the New York AM session, there will be a continuation of the bearishness in price. And in this case, price was bullish here, and in the New York PM session, there was a continuation, not that strong of a movement upward, but a continuation upward. Okay, so what are the specific time for the New York PM session macro? These are 3:15 p.m., 3:30, 3:45, and 4 o'clock. So I'll mark out those times here, and you see how price reacted with them at those particular time. So 3:15, this is 3:15. Yeah. Let me give it a different color, green. Yeah. This price is bullish. 3 3:30, right? 3:45 and 4 o'clock. Okay, so these are your New York PMs. Why do I keep calling it London? So sorry. These are your New York PM session macro. Okay, so now you see this movement in price, see this gap up, and this fair value gap created. In a minute. Okay, so let me remove the key zone for the New York PM, so this won't confuse you. So this is the key zone for the London New York PM. This and this. Okay, and these are your macros. Okay, um, these broken lines in green, these are your macros. So you see this movement in price, okay, this rally up, and there was a fair value gap being created, a BC, buy side imbalance, sell side inefficiency, in price traded into it, filled it in, and rallied up, okay. And also, why rallying up, it created this high, and see how price traded above this high, okay, shows that okay, there's a continuation in price, okay, in the bullishness of price, there's a continuation upward, okay. And it also created another fair value gap here, this run up. So this actually, this right here, this bearish candle, this down close candle, this is an order block, okay. So an order block is a change in state of delivery in price. So this down close candle is a sell side, it's an offer of sell side delivery, okay. And the moment this bullish candle, this green candle right here, this up close candle trades above this down close candle and also closes above it, it validates it as an order block. So there was a change in state of delivery in price from what, from sell side delivery to buy side delivery, okay. So this is an order block. So another block being paired with a fair value gap is actually a good setup, okay, to go either long or short. So this is a fair value gap. Okay, so it's the BC, buy side imbalance, sell side inefficiency. Bring this down. So there was no volume imbalance. So we use the high of this candle and the low of this candle. Okay, so this is the fair value gap. Price trading into it. So if you watch, price traded into this BC to continue the movement upward to take out this high. Let me quickly remove this so you see what I'm talking about. So you see, price traded into the BC. Price gapped up, okay, took out this high, created this BC, and traded down into it to take out this high, and also this one right here, okay, at the New York session. So let's say your target was at these points, okay, this is where buy side liquidity lies. So right, okay, this is where buy side liquidity lies, okay. So let me take this off. I'll call them out one after the other. So the first was 315, right? So wash, yeah, 315. Black. So at 315, that was when this candle was being created, okay. And after this candle was created, that was when the fair value gap also was created, okay. So at 315, the fair value gap was already visible. The BC was already visible, and also price has traded above this high. Okay. Then was 3 the next is 330. So 330. So at 330 we can see price has traded into the BC. This is a 5 minute time frame actually, and this is good. Oh, For those who might not know, it's gold. So at 3:30, you can see price already trading into the 5 minutes fair value gap. Okay. So one, if you know price will continue to rally up, you can go long here. So your stop loss will be at the bottom of the other block. Then take profits top here. Actually, this is a 1.25 risk reward. If I was to trade this, if I was to have an opportunity to go long here, I won't, because the risk to reward is very small. Okay, that's why sometimes like this, I prefer trading with, in price runs like this, I prefer trading with a 1 minute time frame, because then there you have a good opportunity and you grab more risk to reward. Not all the time, but though 5 minutes for most people is cleaner. Okay, but sometimes I do prefer using the 1 minute time frame. So next is 3:45. So this is 3:45. You see, if you notice at the macros, at the New York PM session macros, price is giving you the opportunity to go long at this point. Why? Because there is about to be a movement. You understand? Because the markets will start to spool to liquidity any moment from now. You understand? So this is the time where the markets will start pulling to liquidity or a place of interest. So at these macros, it offers you opportunity to either go long or go short, depending on where it's aiming at, where price is going to rally to. Okay. Then the last was 4 p.m. Okay, at 4 p.m. it's already at the top. But after 4 p.m. you can see this drop right here. So let's go to the 1 minute and see how this looks. Okay. This was that 5 minute fair value gap. What should I name it? 5 minute BC. Buy side imbalance, sell side inefficiency. Okay. And on the 1 minute, okay, you can see the run up in price, taking out this high, right? Taking out this high. In the 1 minute, your focus should be on these two fair value gaps, this one and this one. Okay, this was actually the one price made use of. So I will annotate this and color it. Okay, let's give it this color. Okay, now watch. Price was traded above these highs right here. Okay, showing willingness to rally up further. Okay, now once you spot with the fair value gaps and you know there's going to be a continuation in price to go up. Okay, so you anticipate price to trade down into this fair value gap right here, but you also give chance, like while placing your stop loss. Okay, let's say you put in a buy limit here. Why placing your stop loss, you don't place it here, you place it somewhere here or here. You know, so you give price room for price to trade into uh, this other fair value gap created at the bottom, because price might actually run down to this level. You understand? And this is actually the level where the 5 minutes order block is being found. Okay, so price might actually run into this fair value gap at the bottom. Okay, not all the time, but sometimes. So you have to give room for it while placing your stop loss to be safe. Okay, and let's check this out. Okay, this is close to a 2 weeks to reward ratio actually. So it's actually a good one, up to 2 weeks to reward ratio. Not bad. But our discussion is mainly on how price use these macros. So this 3:15, the price has taken out this high, yeah, and it's running upward. and at 3:30, exactly at 3:30, price already traded into the fair value gap earlier at 3:13 and 3:20. At 3:30, it traded into it again. At 3:45, you can see price still close to the 1 minute fair value gap. Then at 3:40, at 4 o'clock, price was already rallied up. Okay, so at 3:30 and 3:45, there are actually opportunities to go long at this particular price leg. Okay, so go long and target buy side liquidity, which is on top this eye, not eyes. So I hope you found this insightful. For a complete gold backtest, click the link. Click the London session and the New York session linked on the screen. See you next time. God bless.